Hello class, and welcome to the video lecture for Accounting for Merchandise Inventory. Learning Unit 4 is about estimating the cost of ending inventory instead of using one of the traditional methods. There are two methods of estimating inventory. The first is the retail method, which is a method used to determine the value of the ending inventory using a cost to retail ratio. The second is the gross profit method, which is a method used to determine the value of the ending inventory using a predetermined gross profit rate. Let's look at the retail method first. To use the retail method, a business needs to know three things. First one is the value of beginning inventory at cost and at retail. At cost means the cost to the business, and at retail means the selling price of the inventory. The second one is the value of net purchases at both cost and retail. And the third is net sales at retail. Remember that net sales equals sales minus sales discounts minus sales returns and allowances. The retail method is done in 4 steps, which are listed on page 567 of your textbook. And let's look at the example. Remember that the business has to have some information to do this, which is given in the example. We have beginning inventory, which is valued at $4,100 at cost and $6,900 at retail. Next we have net purchases, which is valued at $7,900 at cost and $13,100 at retail. Now let's follow the steps. Step 1 is to calculate goods available for sale at both cost and retail. Goods available for sale is beginning inventory plus purchases, which is given in the example. If we add those together, we get goods available for sale valued at $12,000 at cost and $20,000 at retail. Step 2 is to calculate the cost ratio, which is cost of goods available for sale at cost divided by cost of goods available for sale at retail. That means divide 12,000 by 20,000. So we get 60%, or you can write that as 0.6. Step 3 is to subtract net sales at retail from merchandise available for sale at retail. Remember, net sales at retail is one of the numbers we have to know in order to do this, so that number is given as $14,000. We calculated merchandise available for sale at retail in step 1 to get $20,000. Now $20,000 minus $14,000 is $6,000. Step 4 is to multiply the ratio from step 2 by the number we arrived at in step 3. 6,000 times 60% equals $3,600. So $3,600 is the value of ending inventory, and this is the number we use for inventory on our balance sheet. Now let's look at the gross profit method. To use the gross profit method, we need to know average gross profit rate, which is calculated by taking gross profit and dividing it by net sales. Let's assume we have an average gross profit rate of 30% of net sales. This means 70% is cost. For every dollar of sales, 30% is profit and 70% is cost of goods sold. So step 1 is to determine cost of goods available for sale. Cost of goods available for sale is beginning inventory of $100,000, or excuse me, $10,000, plus net purchases of $4,000. So this equals $14,000 cost of goods available for sale. So step 2 is to estimate cost of goods sold by multiplying the cost of goods sold percentage of 70% times net sales of $6,000. excuse me, this equals $4,200. This is an estimate of the dollar value of cost of goods sold. Step 3 is to subtract estimated cost of goods sold of $4,200 from cost of goods available for sale of $14,000 to arrive at an estimated inventory of $9,800. The last part of Learning Unit 4 is about how an error made in calculating ending inventory will impact financial statements. So assigning costs to ending inventory can have an effect on cost of goods sold, gross profit, net income, current assets, as well as owner's capital. This slide shows the cost of goods sold calculation on the income statement. On the left is the correct version, and on the right is the incorrect version. These are for the years 2012 and 2013. At the end of 2012, ending inventory was calculated as $70. That's on the very first column on the left side. We use that number as the beginning inventory in 2013. You see how the arrow moves from the ending inventory of 2012 to the beginning inventory of 2013. So our profit is $145 in 2012 and $245 in 2013. Now let's look at what happens if we incorrectly count inventory and record it as 60 instead. So now we're looking at the example on the right hand side. You see 60 in blue. So our gross profit in 2012 decreases by 10, and this means gross profit is understated. It decreased by 10, so that means it's understated. Understated means it's less than it should be. Now if we keep using that incorrect number of 60 and carry it over to 2013, our gross profit in 2013 is 10 more than it should be. This means our gross profit in 2013 is overstated, which means more than it should be. So this example is shown to emphasize the importance of valuing inventory correctly. Mistakes can impact assets on the balance sheet as well as owner's equity. To wrap up this chapter, I want to point out that I don't expect you to memorize the steps and formulas for estimating ending inventory described in this learning unit. However, I do expect you to learn their names and the key components of each. So to review, we had the retail method, in which we calculated a cost ratio and applied that ratio to ending inventory at retail. And then we have the gross profit method, in which we applied a cost percentage to net sales.